This video is an introductory video on options for beginners. You are going to learn mostly theoretical concepts of options with real-world examples wherever applies. I will mainly cover why option contract is called derivative security, call option versus put options, how you trade options, American versus European options, values of options at expiration, and option strategies. Let's start with derivative securities first. Derivative securities, or simply derivatives, play a large and increasingly important role in financial markets. These contracts are used to hedge the risk. These are securities whose prices are determined by or derived from the prices of other securities, namely an underlying asset. Examples of derivative securities are forward, futures, swap, and options contract. Our subject matter in this video is options. As an example, a stock option contract on Microsoft is a derivative contract because the option price is determined from the Microsoft stock price. This option can be call or put. A call option gives its holder the right to purchase an asset for a specified price. The call option on Microsoft at $285 expiring on April 22nd means that the holder has the right to buy 100 Microsoft stock at a price of $285 each on the expiration day. The option holder will have incentive to exercise this option only when the stock price at expiration day is above $285, generating a positive cash flow. If you go to Yahoo Finance and search for MSFT and click Options tab, you are going to see the options chains for each expiration date lined up with their strike prices. As you can see, these are call options that will expire on April 22nd. The option contract with $285 strike price is out of the money option because the market price of Microsoft is now $280, which is below the strike price. Now, we will go over a few terms. $285 is the strike price or exercise price. 2.28 is the price of this option. You need to pay $228 to buy an option because one option contract equals 100 stocks. The price or premium that you pay to buy this option is your cost, but this is the profit for a contract seller. You can only make money when the stock price is above $285. Right now, it is an out-of-the-money option because this option will generate negative cash flow if option holder decides to exercise. Thus, by default, this option is marked as out of the money and cannot be exercised. All other options in the shaded area is in the money options, which can be exercised by option holder anytime they want. As today's price is about $280, the option with strike price of $280 is called at the money option. Option premium has two components, extrinsic value and intrinsic value. All the out of the money and at the money options have zero intrinsic value. Here's the breakdown. The price of $280 strike option is 4.45 plus 0. 4.45 is intrinsic and 0 is extrinsic. In total, the price is $4.45. The price of $275 strike option is 5 plus 2.6 equals 7.6, where $5 is the difference between strike price and current market price. On the other hand, the put option gives the contract holder the right to sell underlying asset at a specified exercise price on or before a specified expiration date. The put option on Microsoft at $275 expiring on April 22nd means that the holder has the right to sell 100 Microsoft stocks at a price of $275 each on the expiration day. The holder will have incentive to exercise this option only when the stock price at expiration day is below $275, generating a positive cash flow. The option contract with $275 strike is out of the money option because the market price of Microsoft is now $280, which is above the strike price. You can only make money when the stock price is below $275. Right now, this put option is an out of the money option because this option will generate negative cash flow if option holder decides to exercise. Thus, by default, this put option is marked as out of the money and cannot be exercised. All other options in the shaded area is in the money options, which can be exercised by the option holders anytime they want. As today's price is about $280, the option with the strike price of $280 is called at the money option. Now let's talk about how you trade options. You can open a brokerage account with any stockbroker such as E-Trade, Ameritrade, Webull, or Robinhood. You must get the option trading approval from the broker first before you start trading. But the process is very simple and mostly broker formality. As for the types of options, there are two types of options. An American option can be exercised on or before the expiration. However, the European option can be exercised only at expiration. Let's take a look at the chart to understand option payout profile. As an example, the cost or premium of this $80 strike call option for the buyer is $14. The break-even is when the underlying stock price goes up to $94, beyond which the option holder will continue to make money. Thus, the maximum profit the option holder can get is unlimited, but the maximum loss is limited by the premium, which is only $14. The payout profile for a put option is just the opposite of the call options profile. Here, the holder breaks even at $80. The maximum profit potential is $80 because the stock price can fall up to zero. The maximum loss is the option premium. The payout profile for the seller or the writer of the option is going to be the mirror image of the buyers. Based on the above discussion, we can conclude that a call option buyer can profit from rising stock price. The put option buyer can profit from falling stock price. If you remember this rule, you can decide when to buy call or when to buy put. Let's take a look at some option strategies. There are countless number of option strategies available for you to hedge your risk. I am going to mention few of those that are most common. Protective put, which is used to limit the loss of a declining market. You buy a protective put when you already have the underlying stock. This put option will work like an insurance for your stock position. Of course, this insurance comes at a cost, which is the put option premium you paid. Covered call is a purchase of 100 stocks and the simultaneous sale of a call option on that stock. Now, you are the writer of the option and receive the premium. If option holder exercises the option, you need to deliver the 100 stock to that person at a strike price. If not exercised, you keep the stock and the premium. Straddle. The long straddle is established by buying a call and put option on a stock with the same strike and expiration date. You establish a straddle position when you try to make profit from declining or rising stock price. The strategy is more appropriate when a company is going to announce a major event which can cause the stock price to either go up or down. I am not going to discuss many other option strategies in this video, but you can take your time to explore those if interested. I hope you now have the basic understanding on option contracts. I will share more information in future videos. Thanks for watching this video.